This is our video lecture for chapter number 5, where we continue from chapter 4, working with inventory. Before we take a look at the detail here for chapter 5, let's review what we had learned in chapter 4. So let's say this box is your store, and really it represents our account that holds the inventory called merchandise inventory. This is an asset that's increased with debits and reduced with credits. So again, here's our store, and sitting in our store at the beginning of the month or year is stuff we had not sold from last year or last month, called beginning inventory. It's sitting here in our inventory account. And then during the year, we buy some more stuff. We call that purchases. And of course, we buy it from our suppliers or vendors, which is another business. And in turn, we're going to sell this inventory to our customers, which are either consumers or other businesses. And whenever we buy, it's going to add to the beginning inventory, increasing what's available for sale. So in chapter 4, we had learned a figure called cost of merchandise available for sale. This is the maximum amount of merchandise here we're putting into this inventory. Adding to what we can sell is cost of merchandise available for sale. And either you do two things. Either you sell it, here we call this going out cost of goods sold, or you don't sell it. That means that what's left over, the ending inventory. In other words, these two, purchases plus what you already start off with in beginning inventory, equals what's available for sale. And either you sell it, cost of goods sold, or you don't, ending inventory. These two figures equals cost of merchandise available for sale. These two figures, when you add them, equals cost of merchandise available for sale. So if I give you 1, 2, 3, 4, 3 of these 4 numbers, you should be able to figure out the missing number. So let's go through some of the journal entries. So when you buy merchandise, remember you're going to increase the merchandise inventory. Let me call this number 1, debit merchandise inventory when you buy. So we know in double entry accounting, for every dollar debit, you gotta credit another account for the same dollar amount. So what do you think I'm crediting here? Well, if I paid cash for this merchandise I'm buying, this will be crediting cash asset, reducing. But a lot of our purchases, because they're big, we're eventually going to pay later on. So right now we owe this money. We owe a liability called accounts payable. And when you credit an accounts payable liability, remember you're increasing that amount you owe, increasing the liability. So that's the typical purchase of merchandise, adding it to the merchandise inventory, to what's already there, the beginning inventory. Now when you sell the merchandise to your customers, if you remember in chapter 4, there's not just one journal entry but 2. So you're going to take it out here of the asset account, let me call it number 2, and there's another account we're going to debit for number 2. Remember, debit, credit for same amounts, at least 2 different accounts. So what's the name of this account? Well, again in chapter 4 we learned the biggest expense means cost used up for a merchandising company, here increase with debit, is this cost of goods sold. Reduce the asset, credit. Increase the cost of goods sold expense, debit. Again, we learned there's 2 journal entries every time we sell to a customer. One is the cost and the other is the revenue. So if you remember, let's see here, sales account, sales is a revenue account, increase with credits. I'll call this number 3. And then we know we need to debit another account for the same dollar amount here. So what is this? Well, if you sell to your customer and they give you cash right away, this would be cash debit, right? But if it's a big customer, you're probably going to collect your money later on, and that's represented by the asset accounts receivable. Okay, increase with a debit. So again, 2 journal entries, recording the revenue, debit, credit, and recording the costs, debit, credit. Now here in chapter 3, we're focusing on really this amount here. What's the amount we take out? Now we know we're going to pay eventually the supplier, so that's not really a question of the dollar amount here for number 1. And we know here the customer will pay us the amount, whatever we charge them. But the amount of cost you take out when you sell to customer can vary. There's options here. We're going to see there's like 4 different options, 2 different systems to calculate this amount of cost going out of our inventory. One of the, well, let's take a look at the next slide. So we need to determine how much is sitting in that inventory asset. And we saw in the past chapter there may be some questions when goods are being shipped to us or from us to our customers. So let me go back to that previous slide. So here's a supplier sending us merchandise. So let's say at the end of the year, December 31st, they're shipping it to us. And here is the shipping point. And here is the destination. And we saw there were terms called FOB, shipping point, and FOB, destination. And this will determine who owns the merchandise while it's in transit. So again, December 31st, and it's shipped right here, FOB, shipping point. Do you own the merchandise on December 31st, or does the supplier own it? These FOB terms indicate when title, when ownership passes. So if it's FOB shipping point, you own it right here on December 31st. So let's say another supplier ships you merchandise with terms of FOB destination on December 31st. And because you're probably not going to get it by December 31st, but next year, which is just a couple of days away or just 1 day away, it's not going to be included in your inventory because it's still inventory of the supplier. Now keep in mind, on the other side of your store, you're shipping merchandise out to your customers, FOB shipping point, and it's going to be arrive here, FOB destination. And depending upon the terms you sell it at, it may or may not be included in your merchandise inventory. If it's FOB destination, you don't record the sale. You don't do this debit credit and debit credit until it gets here. If it's FOB shipping point, right here, once it leaves the docks of your shipping store, in the back of your store, you got to record this 2 journal entries. Okay, so depending upon the terms, the shipping terms, that may determine whether that inventory is still in your inventory account at the end of the year. Consignment, let me illustrate that again by looking at this diagram. So let's say you have a big customer here that resells to other customers or consumers, but they don't want to buy merchandise from you to resell it. So what you can do is to help sell your goods with this customer is to set up a shop here. Let's see, if you go to maybe Best Buy, you can see different departments. Maybe one of the departments is like for phones, and they're charged by selling only phones. So what you can do is take your inventory out of here, not sell it, but stock it here, and have your customer sell it for you on consignment. You're the consignor, and here your customer is the consignee, and it's still part of your inventory, what's stocked here, and they sell it for you, but of course you're going to give them a commission, right? So this inventory on consignment is your inventory, not your customer's inventory. In turn, your supplier, if you're a big store here, they could set up a department and move their inventory here on consignment, and you would not include this in your inventory asset. It's really your supplier's inventory. So that's consignment. Also, we'll see at the end of this chapter, we may want to reduce the amount of cost we hold in inventory if it's damaged or obsolete. So how do we know what's being tracked in our inventory system, our accounting system, is accurate? Well, you really don't know until you actually go into your store, in your warehouse, and take a physical count. Yeah, you count 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, you tally. So here's an example of a tag they would kind of stick onto those counted items and write in the amount, yeah, and the person who counted. Of course, things are really computerized now. If you look at almost any product, there's some type of barcode, a UPC code. So basically the counters would just scan the code and then enter in their counter, in their device, some type of quantity count. And then eventually someone has to double check their work and match it up let's go back to my screen here, match it up with whatever you show here as the inventory in your accounting records. You don't really know whether or not the inventory records is correct unless you take a physical count. Okay, and usually you do this at the end of the year, at least once, if not more often than that. And most times you're going to find out the physical count is less than what your record count shows. Now, why would that be? Well, things, let's see if I can jump to that screen. Things may leave your store, maybe not by checking it out through regular means, right? But kind of evaporates or disappears, or pilfering or shoplifting. And of course, you're not going to credit your inventory when someone shoplifter takes it out because you don't know it's taken out, right? Until you take that physical count. And at that point, you're going to have to reduce your inventory, and probably here the offsetting debit to the credit is to deduct it as a cost of goods sold expense. Here in chapter 5, we're going to learn there's different options of calculating the cost of our inventory and the cost of goods sold. There's two broad methods or two systems of inventory. The main system we're learning here in chapter 5 is called perpetual. We continually should know, or at least estimate, how much inventory we have perpetually throughout the month of the year. And here under this other method that we would emphasize a few years ago, called periodic, you would only know how much inventory you have left over when you count. Now, we saw in the previous screen you still have to count even if you have a perpetual, and definitely have to count if you have periodic. And you only know here periodically how much is sitting on your store shelves or warehouse. Now, to assign dollar costs to what's leaving your store and what's still here as ending inventory, here you can see 1, 2, 3, 4 different methods of costing. And we'll go through a comprehensive example. And this is the key thing, or the primary thing in our chapter, to calculate cost of goods sold and ending inventory using these 4 methods. The periodic method is covered in the appendix at the back of our chapter 5, I believe on page 224. And you need to take a look at that appendix regarding periodic inventory to work on the last homework assigned for this chapter. Here you can see in this pie chart the popularity of those 3 or 4 different methods. This FIFO method is the most popular, and then LIFO, and then the average. That specific identification method is probably in this small number here. FIFO, standing for first in, first out, means that the items that came in first, like your beginning inventory unsold from last year, is the first items to be sold. So when you try to figure out what's left over, it's probably the last purchase is going to be in your ending inventory. Here it says the regular flow. Yeah. So if you look at, let's say, maybe a pipe, and you sell bowling balls. So here's a bowling ball, and you're buying bowling balls and you put it into this pipe, and when you sell them, you don't take them out from this end, but you take it out from this end. So what you're selling here first is the old item that came in first, and what's left over here at the end of the month or year is the item that came in last. Okay, the term FIFO is really describing here what's coming out, the cost of goods sold going to your customer. The item that came in first, sold first. Now, just because your physical flow is like this, old stuff sold first, last stuff still here, it doesn't mean you have to assign the costs exactly that way. So here we flip the costs. So again, if you were to picture this selling bowling balls, let's have we have a barrel, and here is the old bowling balls at the bottom of the barrel that you had bought a long time ago, and the new ones you put on the top. So when you sell, you pick off from the top, not from the bottom. You're using this cost, the new cost, when you sell. Now, physical flow probably is going to be this, right? You want to sell the old stuff first. But cost flow under this LIFO method, the last item in, we're going to take that cost and use that as our cost of goods sold right away for our current sales. So what's sitting here at the bottom is the old, maybe even beginning inventory that you started off with. Again, this is the cost now, not the actual flow. Cost doesn't have to match the flow. In the case like for LIFO. Now a compromise to these two is to calculate an average, a weighted average. We'll see the actual calculation is the numbers are going to fall in between the FIFO and the LIFO amounts. The cost of goods sold for weighted average and the cost of goods sold for ending inventory for weighted average will fall in between these two options here. So here's our comprehensive example where we start off the month of August already with 10 units that we didn't sell from last month. It cost us $91 for, when we multiply across it, we call this extensions, $910. Then we made 3 purchases during the month. Notice that the prices for 1 unit per unit is increasing here, here increasing, price for 1 unit. We call this inflation, and because of inflation we'll see a certain relationship to the numbers for FIFO versus LIFO. And we have 2 sales here during the month. Here's our sales price. Of course we're going to sell it for more than what we bought it for, and of course the difference is a profit we're making. So let's take a look at the first method of costing called specific identification, where we have to be told, we're the accountants now, we have to be told exactly which items were sold. So we're told that 8 bikes came from this beginning inventory of 10, and another 12 bikes sold came from this first purchase of 15. So we take the 8 and multiply it by the per unit costs. We take the 12 and multiply by per unit costs, and that's going to be the cost of the 20 bikes we sold. So you're keeping 2 of these old ones here at $91 and 3 of these $106. That's going to be your inventory balance after selling these 20 bikes. So here's the calculation. The specific items you sold at their actual costs, and here's what left over. We call these layers of inventory. You got to know which layer you're selling from under the specific identification method. So now when you buy some more, here's 2 more purchases, you're adding 2 more layers to what's already there, this layer and this layer. And again, when you make a sale here on August 31st, we're going to be told which specific items are sold, from which layer they're coming from, and you got to use their actual costs. So you can see we're using up the rest. This 2 plus this 8 at 91 is using up all of this. This 3 plus this 12 is using up all of this. 15 of this 20 is being used, so you have only 5 left. 3 of this 10 is being sold, so you have 7 left. So what's left over here in the inventory balance is going to be 5 at 115 and 7 times 119. If you add up those two, it should come out to this number. All the rest of the cost is now going to be deducted as cost of goods sold. This figure here, well, at least for this sale. Okay, next method called FIFO. The term FIFO is describing what's leaving your store. The item that came in first, this beginning inventory, is first to be sold. The item came in second to be sold. The item that came in last, probably still here as our ending inventory. Again, we're selling the same number of bikes here, 20. So the first 10 is coming from this first layer, and then of this 15 we're taking 10 out and selling them. So that means what's left over in this $530 is 5 at $106. 5 times 106 should equal this number here that's left over. Here's our cost of goods sold, adding up the 2 layers. Credit inventory, reduce inventory, and debit the cost of goods sold expense, leaving this as your balance. And then you buy some more, so you have 5 from here, 20 more from this purchase, 10 more from this purchase. But under FIFO, you got to use the old stuff first. So here you can see the 5 being sold, and then 18 from here, leaving you 2 left over, right? 2, and this 10. These 2 times their price should equal the leftover balance in your inventory asset. Okay, all this amounts here you're taking out of inventory, crediting inventory, and debiting cost of goods sold. Last in, first out. Just like first in, first out is describing what's leaving the store. The item that came in last before any sale is what you sell first. So here, before first sale, the item that came in last is this purchase right here, and not this beginning inventory. Okay, so now we're going to sell those 20 bikes. Here's all 20, and the first place you sell under this LIFO method is the last thing that came in. So that means we're going to take 5 of the beginning inventory and move it here to sell to the customers, leaving 5 at 91. 5 times 91 is the ending balance now left over in our inventory account. And here you're taking out of inventory this cost for cost of goods sold going to your customers. Then you buy some more and some more. Now when you sell here on August 31st, the item that came in last is this, and now you're going to sell it first. So all of this 10 is sold, and you need another 13. So 13 is sold from here, leaving 7. Okay, so I think what's left is 5 from here and 7 from here. If you multiply it by its prices, extend it out, you'll get this cost left over in the ending inventory. All the other costs has been moved out of the inventory, credit and debiting cost of goods sold. Now, a compromise between the FIFO and LIFO method is to take an average cost. Now, if you remember, the beginning inventory plus purchases is equal to a figure called cost of goods available for sale, or merchandise available for sale. And you have to figure out an average every time you buy more merchandise. So you make a purchase, refigure out the average. Make another purchase, refigure out the average. Now when you sell merchandise going out to the customer, you don't refigure out the average. Whatever is remaining has the same average cost. Okay, here's the formula. You take your cost of goods available for sale to date, beginning inventory plus purchases to date, and you divide it by the amount of units that represents. So here in our example, we start off with 10 in beginning inventory, 15 for the first purchase. Remember, every time you buy a new merchandise, you got to refigure the average. So you take your total cost here, 2,500, and divide it by the 35 units to get a 25 units to get an average of $100 average, weighted average. Again, every time you buy, you got to refigure out the average. But the next transaction is to sell. We're selling 20 units at that new average cost of $100. And the remaining 5 have an average cost of 10. But now when you buy 20 at this different price and 10 more at this different price, you got to refigure the average. So you take the old remaining cost plus the new costs, to get this total cost, and you divide it by, let's see, that's 35, right? You have 5 left over. 25 minus 20 is 5 left over, plus 30 more, or 35. You're going to take this cost and divide it by 35. You're going to take that cost and divide it by the 35 units left over to get a new weighted average. Okay, we didn't take a new average after selling. We took a new average after buying before the next sale, which is August 31st. Here's using the new average cost, 114 we had figured out in the previous screen. So again, whatever's remaining here has the same average cost, 12 units left over, averaging cost of 114. This times this should give us this here, inventory balance. You only figure out a new average when you buy. You do not figure out a new average when you sell. Okay. So here's a summary of all 4 methods. Notice the sales price we're collecting from the customer is all the same no matter which method you're using, specific ID, FIFO, LIFO, or average. What is different is the blue numbers. Okay, this is slide 24. Let me jump back to slide 2 at the beginning of this lecture. If you remember, here's the cost of goods sold, cost going out, and there's like, what, 4 or 5 methods to calculate that. And here's the ending inventory. These two has to equal these two, the cost of goods available for sale. So if one goes down, cost of goods sold go down, the ending inventory goes up. Or if ending inventory goes down, the cost of goods sold has to go up. If one goes down, let's see, let's choose this FIFO. Notice this is the we'll kind of ignore this specific ID, but just focus on these three here. Of these three, here is the small s cost of goods sold, because it's deducting the old cheaper costs. Remember, we have inflation. And what's left over, the ending inventory asset on the balance sheet, not here part of the income statement, it has the more expensive, newer inventory purchases we bought, right? If one is relatively low, the other has to be relatively high. And because of inflation, the LIFO gives us the more expensive costs being deducted, the last item that came in. And the LIFO shows us the smallest ending inventory of these three here. Now when you compare these two with the average, weighted average method, this number falls somewhere in between these two numbers here. This number falls in between, somewhere between these two. So you can kind of tell if you're on the right track depending upon which is larger, keeping in mind this is inflation. If you saw those rising prices, FIFO will give you the smallest cost of goods sold, LIFO will give you the largest. Now if there's deflation, and has been deflation for some items in the past, although inflation is more common, just the opposite would be true in terms of which is relatively bigger and smaller. Now why would people use these different methods? It's not just to confuse you guys, you have to learn all these methods, but each method has its advantage. So here's, at least for those three, the average kind of smooths out any increase or decrease in the cost that you buy. Whereas the FIFO method, if you look at the ending inventory in the balance sheet, it's going to be very close to the replacement cost, because it's at the more expensive price that you probably have to spend to replace that ending inventory. But if you take a look at the income statement where you're deducting the cost of goods sold, the LIFO method has the more current cost, the higher cost in the case of inflation, probably better representing how profitable you were for the year. Also, because the cost of goods sold during inflation under LIFO results in a bigger, let's see if I can go back here, a bigger cost of goods sold, your profit is going to be smaller and you're going to pay less taxes, at least temporarily. Yeah. So a lot of big companies, even though it may be not as logical as the regular FIFO flow of costs, they would keep track of costs with LIFO just to save taxes here. And the IRS rules, let's see if we can take a look at the IRS rules. Uncle Sam here says that if you use the LIFO method for tax reporting, you also got to use LIFO method on your financial statements. Now, if you want to show profits for whatever reason, to show other people you're a very profitable company during a period of inflation, you would probably use FIFO, right? But if you want to save taxes during inflation, you would use LIFO. Here's a rule saying that if you adopt one method, you got to stick with it. Here called consistency concept. And you really cannot change your costing method of inventory just to save taxes. You have to have a legitimate reporting business reason to do so. Okay, so now you can compare one year with the next year to determine whether you're profitable or not just based upon changing inventory costing methods, but based upon how much you spent for inventory and how much you're collecting from your customers. Okay, for the past slides, for most of the chapter, we've been focusing on the cost of the inventory, the cost of what was sold to customers. Now at the very end of the year, what you gotta do is take a look at your inventory and ask yourself, is this inventory really worth that amount of cost I paid for it? Now if you can replace your inventory at a lower cost, not selling it to your customers now, but buying it from your suppliers at a cheaper cost than you had recorded at, what you got to do is record that lower amount. Here the rule is called law of cost or market. The word market is kind of misleading. It really represents replacement costs. How much you would pay your supplier to replace the inventory that you still have in hand versus the cost you had actually paid that supplier. So this concept can be applied in 3 different ways. So let's take a look at the example here. Our small company sells 4 different items here in 2 broad categories. So one way of applying this law of cost or market is to take a look. In the case of, let's say, this Roadster, we had paid $8,000. But if we were to replace it from our supplier, these 20 Roadsters, we would pay $7,000 each. So here the law or cost or market would be $6,000, and you would pick the law for each of the 4 items. So that's one way of applying this law of cost or market. Or you can take a look at this category. Again, we have 2 categories, right? So here the law of the 2 categories amounts for 1 category. The law here for 1 category, this amount here, I think, yeah? Or you can compare the whole, sorry, it's this amount here versus this, yeah? So not this one here, these 2 in category. This one and this one will be the lower. Or you can compare the whole company. Now, which is lower? This amount here. So here's a kind of summary, at least for the first one. In the case of category, what's lower is 200,000. What's lower is 85. Or here for the whole company, what's lower is 286. Now you compare this to the actual costs. Actual cost. This is what's in your records right now. And whatever method you pick, you gotta reduce this inventory down to this amount. Credit the inventory for the difference. And you're gonna debit, just like we've seen before, cost of goods sold to get rid of the costs. Okay, last couple items here is to analyze your merchandise. How well are you doing? Not just in terms of dollars. Well, I guess this is an analogy. So let's say you're driving a car and you want to see how much you're driving the car or how fast you're driving the car. So if you know the odometer reading, how many miles you drove, that would be just like this number by itself here, how big the number is or small the number is. Another way of measuring how you're driving is your speed, the speedometer, the miles per hour. So basically this inventory turnover is measuring how fast you're selling, how fast you're driving your company. So the formula is to take all of that cost, your cost now, not your customer's cost, but the cost of goods sold that left your company, and divide it by the average inventory you held during the year. Average means to take the beginning of the period and ending of the period total and divide by 2. So what this is going to tell you, so let's say, again, here's our store, and you fill it up. Yeah, you buy it up. Then you stop buying. Then you sell the whole thing, right? One time, the whole store. Then you fill it up again, and you sell it again. So the question is, how many times of filled stores did you sell during the year? And of course, more the better. So your answer here, this inventory turnover, picture it as how many store full inventory did you sell? Is it 5 stores, 6 stores? More the better. Yeah, you want your average inventory to be small. You don't want to stock too much at any one time. Of course, you don't want to lose any sales to be under stock, but you want to put it in and take it out fast. Put it in, take it out fast. High inventory turnover. If you take this inventory turnover, whatever times amount of stores you sold during the year, and divide it into 365, what you get is the answer of days the inventory has been sitting on the shelf before you sell it. Get the average days of shelf life before it's sold. Now related to that is the last ratio here at the end of our chapter called days sales of inventory. Where you take the cost of goods sold again, but this time in the denominator, bottom, and you divide it into not the average inventory, but the inventory you have at the end of the year. And this is going to be a fraction of the year of inventory you have left over to sell. And if you multiply that by 365, this will give you the number of days of inventory you have left over at the end of the year. and you want to have, depending upon what you have in stock, you may don't want to have too big of a inventory. Again, it will just sit there, yeah. Otherwise, and you don't have it too small because you may lose sales. Customers go someplace else if you don't have it in stock. Okay, so this is the end of our chapter 5. Make sure you use the demonstration problem and the primary problem in the chapter and appendix, I think it's 5A at the end of the chapter, to help you with the homework assignment, especially those calculations. Okay, talk to you later.